What we offer investors is more or less direct investment into an extremely cyclical industry, being the tanker market.
What do you think is the biggest misunderstanding that you see a lot of people with influence are telling us about the oil and gas market and shipping even?
One thing you learn after working kind of indirectly in the oil markets for many years is that nobody really has the answer. A feisty hedge fund with an attitude can manipulate that curve very easily.
I'm very excited to be joined by Lars. And Lars, thank you so much for taking the time.
Well, thank you for having me.
You've been on the wait list for quite some time, and obviously we are very interested about your journey and also the story of Frontline, of course. But before we head into shipping, can you go down the memory lane a bit? Because I guess it's fair to say that you started in finance and maybe stock picking and found that fascinating. That was maybe your start in finance at least.
Yeah, I actually have a background then from the equity markets. I graduated with a bachelor in science from a university here in Oslo, and then kind of I was more inspired by the movie Wall Street and hitting the financial markets than I wasn't really considering shipping too much. And to be fair, at that time, as many times after, shipping has kind of been doomed a bit. It's been looked at as a marginal industry that's just going to be effectivized and kind of commoditized and kind of be like boring. But so I started off in the equity markets first as an analyst and then managing a small fund here in Oslo. So that was basically kind of where it started. I had a few friends that were working in the shipping industry, and I remember it was quite funny because during those years, I believe it was Reuters were trying to set up a screen for ship fixing. So basically, where to try and avoid the physical broker in between the cargo owner and the ship owner. So actually as early as that, so early 90s, somebody tried to structure this business.
Can you just describe the equity markets today versus the time you started? Because I don't want to bring up your age, right? But there's a gap between 90s and today, right? So what has changed? Is it much more information? Things go, is it the standard things, or are there something that is really different that you would have you had to be there to understand the difference in the equity markets today compared to your time?
Well, I believe kind of, and I'm not that old, so I don't know how the 80s were, but or at least I wasn't in the equity markets at that time. But I believe kind of every big cycle in the stock markets has its kind of theme, and so the 80s was kind of roaring, with the leverage and M&A, and it was also where kind of high yield bonds kind of came up into play and all that stuff. But the 90s was more kind of dominated by the rapid change in technology. So this was kind of the where Cisco and Microsoft and all these companies started to evolve. So that was a really interesting kind of time. I think here in Norway, it was typically where you started to see funds invest more and more abroad. So, after being constricted to the Oslo Stock Exchange, they started to look across the borders and particularly towards the US. So it changed kind of the dynamics in the investment kind of environment for Norwegians as well. But I think one of the things and this was an important kind of thing for me is that whilst the 80s were dominated by fundamental bottom-up analysis and as I mentioned, you had a lot of M&A activity and during kind of those years, and a lot of leveraged debt and so forth. In the 90s, and this was what caught my attention a lot, you suddenly started to see kind of other ways of investing, one of them being kind of the usage of technical analysis, which was what caught my eye. And also the fund I was working for and the investment bank I was working for at the time had a high focus on technical analysis, using it basically to try and it's a very efficient way of analyzing a broad area of equities, sectors, markets, and this was I found really interesting.
How do we separate fundamental research from technical research? Because if you go deep enough or broad enough, maybe it's just the same, right? So how do you separate those two concepts?
Well, kind of if you are a chartist, to use a fancy word, you accept or you acknowledge the fact that if you look at price action and volume, you actually see the sum of what all the fundamental investors are doing. All the bottom-up analysts are kind of where they're putting their money. And if you say you put your money where your mouth is, you're actually seeing the sum of a lot of people's opinion about that stock or that market or that sector. So it's kind of cheating, you could say. You basically try to quickly get a grip on what a lot of people are thinking about a certain equity. But in order for it to work, it has to be a very liquid stock. It has to be a lot of investors. And the kind of the fundamental thing about technical analysis is that you also assume the market is efficient, that information is evenly spread. So if it's a marginal stock on an OTC list in a weird exchange where there's 500 shareholders, there is no way you can apply technical analysis. But for the broader markets, for the big, large cap companies and so forth, I'd like to argue that the price action you see on your screen is the sum of people's kind of actions and the sum of a lot of people's analysis of that company or that sector.
Is it fair to say that the downside or maybe a weak point in going about that way when investing is that if you take, it's so much psychology in the market, right? So maybe if you find the right strategy on technical chart, maybe the psychology or the management, maybe you're missing some pieces that can either ruin your conviction or ruin the picture you have made in your Excel sheets. Or is that a bad assumption to say?
No, it is, and I think people listening in has to understand that where this kind of movement erupted in analyzing the equity markets and commodity markets too. This was during the 90s, and during the 90s, one thing it really didn't have was these massive long short hedge funds. You didn't have quantitative models. You didn't have kind of black box trading. You didn't have high frequency trading. And so there was far less noise in the market, and this is why kind of your point is spot on. There can be so many false kind of signals coming into the chartists' world, basically due to all these machines and also a much larger community of looking at the same patterns. So we kind of, if you're an old school chartist, you're looking for head and shoulders and cup and handle and all these kind of formations. The thing is, right now you have massive computers looking for the same, and that will trigger kind of action in the market. So yes, it's a very noisy picture. But if you look kind of from if you put the big goggles on and you're drilling kind of top down, I think it's still very useful.
Quarter den nye måten å gjøre research på selskaper. Deres første oppdrag å gi tilgang til konferansesamtaler, investorpresentasjoner og inntjeningsrapporter så friksjonsfri som mulig rett i lomma. Deres andre oppdrag å skape en helt ny måte for selskaper å nå sine investorer på, og omvendt. Quarter 100% gratis. Det inkluderer selskaper fra 15 markeder i dag og planlegger å legge til flere. De prioriterer alltid etterspurte selskaper, og brukere kan også legge igjen reaksjoner og bli hørt mens investorpresentasjonene foregår. Så følg de på Twitter @QuarterApp. So I'm asking this question because maybe it is a bridge into shipping, but do you prefer working in Singapore or London? Because you've done both, and maybe that has something to do with the shipping industry as well.
Well, I think, well, when I was living in Singapore, it was a fantastic time kind of in my life because I was getting kids, and bringing up kids in Singapore is extremely easy. And you know, you put on shorts and sandals, and that's it basically. But the shipping community in Singapore was really close knit, and it was also kind of very open-minded, meaning that, you know, you'd go to one bar in Bolt Quay in Singapore called BQ, and there you'd meet all the big owners and all the big charterers in one place. So people got to know each other, and it was kind of a very constructive and positive kind of shipping environment. Even though people were competitors working for different firms and so forth, you know, we were all expats basically. So you were all kind of in that same boat, to put it that way. London, it's you know, that's a massive kind of powerhouse for shipping. So and also it's far more fragmented. But I think Singapore is, over time, there's a saying that if you stay in Singapore beyond 5 years, you're going to stay there for 10. And if you stay beyond 10, you're basically done for. And it's some refer to it as a golden handcuffs, because it's basically so convenient to live there. And very easy living. But it's also a bit Groundhog Day for those of you who've seen the movie. You know, you wake up every day, it's the same weather, it's the same, you know, it's a small rainstorm, it's the same temperature, you go to the same places, you do the same thing. So it does get a bit boring, kind of, at least from a family life perspective, in my opinion. So that's kind of where London was far more real life and far more kind of comparable to what a normal Norwegian would look for.
Is it also fair to say that, I don't know today about London, but if we go back a bit, I mean, it's a powerhouse in finance, right, in Europe. So just being in London and understanding how London ticks and moves makes you more capable as a shipping owner or as an asset manager or something like that.
Absolutely. But I think also that has changed a little bit. So I moved to London in 2007, and I think London now is actually less or has been outcompeted a bit by Geneva in that respect. So, you know, due to kind of certain tax changes and so forth, and this is way ahead of Brexit, a few of the bigger trading houses and a few of the kind of the bigger charters in the shipping market moved out to Geneva, and this has then made kind of Geneva also, you know, kind of Geneva and London together is now kind of sharing the throne of being kind of the shipping places to be. But in London, you know, you also got the aspects of get a feel for the financial markets. And I mentioned I moved there in 2007, and it was quite scary, you know, living there in 2008 and into 2009. You know, the shipping market wasn't really hit by the financial crisis until about a year after Lehman Brothers went belly up. But you could really feel it. I lived out in Wimbledon, and you know, in England, it was very common to have houses to let. So you had like a second home that you just rented out because you had free finance from the banks during the, you know, the early 2000s. And you could, during those days, you could walk down the streets and every house was for sale, literally. Basically, kind of Britain's being in a financial squeeze. And it was also noticeable that so many people were let go in city that my commute got less crowded. And that's kind of when you feel that there is a financial crisis going on. And then obviously it feels strange, at least during 2008, being in a relatively tight tanker market, making a lot of money whilst the rest of the world is falling apart.
Definitely. So you mentioned the tanker market, and obviously we're going to discuss that a lot in this episode. So what's the best analogy or summary even of how it is to navigate in the tanker market? Because it's massive if you look at it as data points that matters, right? So how do you summarize working in the tanker industry?
Well, first of all, people have to remember that tanker markets are mean reverting. You know, it's an extremely cyclical industry, and it will eventually move back to a mean, which is somewhere around where you actually get a return on an investment of a ship, a 20-year investment on a ship. You know, the tanker markets will be extremely volatile because you'll have overinvestment in ships or in tonnage, and then underinvestment in tonnage, and then you will have the demand moving kind of really crazy from time to time. But also, I think the lack of, I mentioned on technical analysis, I mentioned efficient markets, information being evenly shared in the market. You absolutely don't have that in the tanker industry at all. That kind of brings me further to the fact that you actually don't have that in oil markets either. When people talk about efficient markets, one tends to look at the currency markets. So currencies are, you know, there is so much information kind of roaming around the currency markets. It's extremely liquid, and you can basically place any size of bet at any point of time. You know, so that's regarded maybe one of the most efficient markets in the world. Tanker is total opposite. So there's a vast array of information that needs to be kind of analyzed and chewed on. And I think just the sheer volatility of the tanker market tells you that nobody really knows what's going to come next.
Can we explain why that is a fact? For people may think that why can't we solve this puzzle to understand the equation more fully than obviously it's the case today, right?
Well, we have actually started to solve it to some extent, and this by the introduction of, you know, just to explain to listeners who's not familiar with shipping. So every ship in the world has a beacon. You know, it's basically a radio signal that's pulsating and being sent out every minute, every hour of the day. And it's an anti-collision system. It's called an AIS transponder. And every ship over a certain kind of tonnage needs to have it. You'll even find kind of pleasure crafts in the Oslo fjord, you know, having an AIS transponder. Really low-tech kind of radio signal thingy. So at some point during mid-2000s, low-orbiting satellites were able to pick up that signal. Prior to that, it was only port states and other vessels that picked up this signal. But the minute low-orbiting satellites could actually catch that signal, that radio signal, and decipher it, it was like the oceans of the world were lit up with these kind of red dots and green dots and black dots that you now can Google, and you'll find them on the internet. But prior to that happening, nobody really knew where your ship was, and nobody really knew what kind of your ship was doing, and when it was expected into the Middle East, for instance, or when it was expected into the US Gulf. And at that time, the owner had kind of half the puzzle, and the charter had the other half of the puzzle. And it was like a kind of, it was, and the, you know, obviously the owner could spoof the charter could spoof the owner, and but it was like kind of an even strength kind of relationship. Once kind of AIS became broadly kind of accessible, and we did it when I was working with Glencore. We utilized that data quite vividly in the beginning, actually to the point where we signed an agreement with a Canadian satellite provider just to buy the raw data to try and get ahead of the curve on analyzing this data. And suddenly you had an overview of every ship's position in the world. And this has obviously driven the market to become more efficient. The challenge for the ship owners is that it hasn't really helped us. You know, it's basically given away our information, but we still don't know how many cargoes there are. You know, the demand side have been able to kind of hide their cards better. But on the other side of it, analyzing the markets, looking at supply and demand in the world, refinery margins and so forth, has also become more accessible. So it means that the owner, if he utilizes it, can also get a kind of a better feel. You know, back in the 90s, most of these markets were trading OTCs, or over the counter. So there wasn't like a Reuters platform you could go to figure out what the jet crack was out in Asia. Now all this is on Bloomberg or on Reuters. So it means that if an owner does his homework or an analyst does his homework, we've kind of managed to even out the odds to some extent, right? We know what economists kind of work. So I would say that the market is getting kind of gradually more efficient, but we're yet not there.
That's fascinating. So if we play out a scenario where you have full transparency through the whole supply chain, who has the most to fear? Or say in another way, like, who is hiding the cards and thereby can make more money relative to others, right? Maybe it's a hard question to answer, but
yeah, but I still think it will be kind of at least for now, it's the cargo owners. You know, it's the refineries. They know what their schedule is going to be like. You know, that they know kind of what their runs are going to be. The refiners speak to the oil traders or the oil majors, or they are an oil major. So they schedule kind of months ahead. You know, kind of a refiner today will probably start to plan for winter demand 2022. So they will kind of know. But kind of where the owners kind of might be able to fight back is on pure S&D in the tanker market. You know, if there is a limited amount of the taxes in the world, you know, kind of knowing the taxes and working together with the taxes will actually start to mean something. We're not yet there, but that was actually the case, you know, during kind of the most extreme bull runs in tankers. It was actually, for a charterer, it was really important to be good friends with an owner and to have a long-lasting relationship with an owner, because otherwise the owner just wouldn't offer. And I think it's like a wet dream of any owner, but you know, you now have almost a whole generation in the chartering part of it. You know, the guys booking ships that never really been to, you know, working in a tight market. They don't know about kind of how important these relationships can be. So hopefully they're going to have a kind of a crude awakening once this market tightens up.
definitely. So if you were to simplify this navigating the tanker market and the oil market, maybe it's easier to first quickly explain the supply side, because obviously that's easier if you look at the order books, and then take demand afterwards, because maybe when people are listening, we talk a lot about what can happen and the news flow, but usually that goes in the demand bucket, right? I mean, the order book, etc. We don't need to use that much energy to figure that out, at least in a pretty confident way, right?
No, the supply side on the tanker side is pretty much done. You know, it's done and dusted. There, you know, transparency has also evolved over the years. You know, people don't hide their order books to the same extent they did before, and also, you know, during 2000s we had an enormous amount of yards, so-called greenfields, popping up left, right, and center on the globe. It's obviously very difficult to maneuver and knowing how much is actually in order and so forth. That has changed because of post 2008, 2009, you know, all these yards were closed down, and now you're back to kind of, for the tanker side, a big handful of yards that can actually build a modern tanker, and what they have on order is more or less transparent. You know, it's worked out, and also their capacity to build is more or less known. So the order book you have a good hand on, and the order book right now is, you know, we talk about these big cycles. The order book now is, so if you rewind to when I entered the tanker market, which was in 2002, 2003, and I moved to Asia pretty quickly. At that time, you know, the tanker market was about half the size it is now in deadweight tons. So the carrying capacity of the tanker market was about half the size it is now. But the order book was actually bigger than it is now. So now, kind of forward wind 20 years almost, or just about 20 years, the tanker market, the overall carrying capacity of the tanker market is double what it was in 2002, 2003, but the order book is in deadweight terms exactly the same. And this is really is almost scary, considering the fact that 20 years ago, we went through a cycle where single hulls were kind of more and more difficult to trade, and more charters and the ports and the terminals and whatnot demanded a double hull vessel. This came kind of, first it was probably started with Exxon Valdez accident, but then you had a big accident in Korea as well, where a ship basically broke. It was a hole in a ship, and the kind of this double hull thing came into play. So basically, during the 2000s, partly due to the single hull, double hull trend, to call it that, and secondly, due to the growth of Chinese demand, there was a vast amount of vessels being built. And as I mentioned, the order book in absolute deadweight terms is now lower than it was during those years. And all these vessels are coming up to 20 years of age. And I think I'll spend a little bit of time on this 20-year thing, because, I can say it until I'm blue in the face, but investors don't really get it, right? And then you have kind of Harbjörn with NAT will tell it, a tanker can trade till it's 25 to 30, blah, blah, blah. It can, but the charters don't want it. And this has to do with the simple fact that, for a charter, for an oil major, one of the things that he's most scared of is an oil spill. Whether if he has to pay, $100,000 more or $500,000 more on freight, that accounts to extremely little for the risk of having a massive spill. The cost to an oil major, say, to have like an Exxon Valdez spill, is enormous. Not, they're insured and all that stuff, but just kind of, you lose, you lose your company kind of reputation. And that goes for Equinor and Total and Shell and all of them. So, and these guys have really rigid vetting departments who are not charterers. And, there is a reason why, a vetting department guy, he's supposed to be an engineer. He's literally being an auditor, internal auditor, to make sure that the kits the guys rent in are of the best quality possible. And a tanker is not a rigid structure. It's a steel, but it bends. It has to bend, otherwise it will break during waves and so forth, going through rough seas. And when something built of steel is bent for 20 years, the probability for it breaking starts to increase exponentially. So this means that, if you have a ship that's more than 20 years old, you have a very limited amount of clients, and you can't really trade that ship very efficiently. So it means that, and this is also the reason why the average scrapping age in the tanker industry is just a year and a half north of 20 years. That's when the ships leave the industry. So now we're getting into both this generation of ships that were built early 2000s that are reaching this 20-year gap or threshold. And we are actually in the market where oil demand is expected to grow. It's actually expected to grow incrementally due to us coming out of a pandemic. And then you have this thing that the order book is actually lower than it was back in 2000s. And the market is much larger. One interesting thing to put that in context is that back in early 2000, the global kind of oil demand was hovering north of 85 million barrels per day, or around 85 million barrels per day. Now, by the end of the year, we're about to reach 102 million barrels per day. And the oil transported on water, which is about 40% of global oil demand, that has doubled in the same period. And the size of the market has doubled, but the order book is, if you compare it, it's half of what it should be in theory.
Is it like, there's probably many reasons for this happening right now, but is it sort of like the perfect storm of people thinking it's peak oil, they need to calculate 20 years ahead, and to make the investments, it needs to make sense in 20 years. And also, if you add on uncertainty on technology as well and regulations, it's just like the perfect storm for people who, and maybe, I don't know, maybe it's an age thing, right? So if you're 50 years old, you kind of need to have, is the new generation as keen as the previous to become great at tankers? Because there's also a reputation on a person to just be in the oil industry. We have to be honest about that as well, if you take the broad lenses, right? So is it just many factors at the same time creating this scenario?
Yeah, I think it is. It's, you know, every cycle has its theme, right? And, you know, when we saw let's take probably the last cycle, where we saw kind of all the tanker fleet and also the dry bulk fleet, to be fair, was completely overbuilt. You know, it was too many orders being placed. That was when private equity or family offices, but, you know, hedge funds and private equity dominated the source of finance into the tanker industry. You know, you were coming through a cycle that lasted from, say, 2003 until 2009, 7 years almost, where ship owners, traditional ship owners, were making insane returns. And then, you know, kind of not that typical investors in shipping, you know, looking into the Bloomberg terminal and seeing, well, you know, if I can get that kind of return, I'm going to put in $1 billion too, right? And we saw, you know, almost like specialized hedge funds set up to finance this. Prior to that, actually, if you go back to the 80s, you had the structure of KGs, you know, which was basically just a tax vehicle, because governments offered tax relief for investment in shipping. And this is where, you know, you had the dentists of Germany became the biggest ship owners in the world. So it's, you know, you go through these cycles where sourcing of capital is maybe the only limitation to the tanker industry. And mind you, a tanker owner typically is very willing to take risk. So if somebody gives him money, he will apply it in the market, at least historically. So, but I think you have a point that, yes, this, you know, the big owners, the big swinging guys that really ran the bat, they're obviously getting older. It's almost like a generation of them who are, you know, reaching retirement. But I think there's also another one is, you know, if you go to university today, are you really looking to go into shipping you know, according to taxonomy, we're a non-sustainable industry. We're actually going to be extinct, right? And if you look at the regulatory kind of framework surrounding shipping, it's becoming far more, you know, more and more complicated to maneuver in. Also, due to and for all the right reasons that we're all going to be more and more environmental conscious, you know, funds and a lot of money are being challenged to something that's greener and that is sustainable. So, you know, transportation of hydrocarbons is not really sustainable, looking at kind of where we are hoping to end up in 30 years time. So I think you have kind of a sum of all that. But then again, I think that once the returns kind of come, you know, once the money is there, I think kind of this is going to slip. There's one thing that I tend to discuss sometimes with American investors, and we call it the Philip Morris kind of case. So Philip Morris were in the 90s, you know, that was when people started to sue Philip Morris for kind of lung cancer and whatnot. And Philip Morris became kind of one of the really, really dark sheeps of Wall Street. But and people, you know, they became uninvestable, basically due to them being the single biggest cause of cancer. And they're probably going to sue me now. This
was the narrative.
Say, you know,
this was the narrative, right?
Yes, that was a narrative. Yes, but if you look at the best investment you could have done on Wall Street by a mile for the last 10-15 years, is Philip Morris. So kind of when the money is there, when the yield is there, when the performance is there, and you know, the dividends are there, people tend to forget, or there are kind of pools of money that are not constricted by kind of the green shimmer, to put it that way.
I'm stealing your quote right now, but I hope it's okay, because you had a great quote yesterday when we were talking about the fact or the idea that you need to go green by black numbers. Maybe it's a great example just to put on the environmental piece as well, right? Because a lot of smart people are obviously trying to solve this sustainable puzzle, and it impacts everyone, right? Trying to run a business.
Mm. Well, I have to arrest you there, because otherwise I'm going to get sued by Bellona, the Norwegian environmental kind of organization. But it's actually their founder, Fredrik Hauge, who's kind of, he's probably going to beat me up now, but he's got a more conservative approach towards how to change things going forward. And he's the one who has this quote, go green by black numbers. Basically that, you know, where you invest your money and where government subsidize and where government actually puts their bet on how we're going to solve the climate crisis has to be, you know, at least there has to be some shimmer of sensibility there. You know, it has to be based on facts. It has to be, and you can't really force, you know, irrespective of how many billions and trillions of dollars you stuff down the throat of kind of various ideas and thoughts and whatnot, you know, what's in the end going to solve it is that there are economics in green industry, you know, kind of in reducing our GHG kind of emissions. So you know, that's the kind of long-term solution, and sometimes it looks like people kind of lose sight of that. They don't understand that we're not, you know, we're living in a society where it actually has to make sense in the end. You know,
I'm trying to get us over to the demand side of the equation, and it would be great to just hear your reflection on where do you need to look in order to understand enough, right? So, I mean, you have the Pareto principle that 20% gives 80% of the results, right? So maybe it's the same dynamic in the demand side. But just one story which I find fascinating is that if you just expect that people in India and Africa and China, etc., Asia, wants to get to middle class, you expect them to use energy, right? People need to burn food, they need to heat up their houses, etc. So if you're just talking about math and facts, don't you have like a gigantic demand side regardless if you forecast ahead to some sense?
Absolutely, and there's you know, I would encourage listeners to go into Google, and I think the website is called Mercator Earth or something like that, I think. But it's basically it's looking at global maps based on where basically the size of the continents are made up of number of people, number of cars, number of middle class people, and so forth. And then you'll see how unevenly distributed kind of wealth is in the world. And you know, there was a person I had a discussion kind of over Christmas where there was one made me aware of an interesting fact. You know, kind of overpopulation is actually one of the biggest challenges we have, and it's very difficult to deal with, of course. But overpopulation becomes less of a problem if more of the world population reaches middle class, because then you automatically get fewer children, or at least statistically. So world growth will, or population growth, which is a huge issue for us, will actually start to kind of ease the more people we can put kind of up the standard of living chain. And you know, I've seen kind of various analysis, and McKinsey has an extensive analysis on this. And they expect over the next, I can't remember if it is the next 20 years or 30 years, probably 30 years, probably towards 2050, that we have 1.4 billion people in the world, which predominantly lives in China and India, which are expected to reach middle class. And this is not middle class in Norway, where basically we're all middle class. You know, kind of that's the floor. But this is like a global kind of middle class where probably the income is around $20,000 a year or something like that. But it's and you know, even though they're not all going to drive cars, they're going to use products that are made of oil. You know, where oil is one of and we don't have a replacement for it yet. So maybe we can build, you know, do some bio-organic stuff that can make your fleece, you know, for sure. But it will demand energy. Do we have the energy? You know, it's all these kind of questions. And so I'm, you know, with regards to oil demand with the long goggles on, yes, hopefully we're going to plateau at some point. And it's very likely we're going to plateau at some point because alternative energy is going to dig into kind of the oil and the hydrocarbon part of it. But we're going to plateau. We're not going to fall off a cliff. So, and if that's at 130 million barrels per day, 110, 120, I don't know. But in the meantime, very few tankers are being built, and this still needs to be transported. And that's one thing, you know, when we have a coffee table discussion here in my household, there are 3 kids who are in the prime kind of green shimmer age, and they discuss it at school and all that stuff. And sustainability is you know, is a normal word being used in the sentences. You know, one thing that can actually, which is an argument that people tend to forget, in tankers, we actually transport an enormous amount of energy really efficiently and distributed around the globe. So it's, you know, if you were to put that oil that, you know, say a VLCC can carry into trucks, you know, you would need probably 1,000 trucks, and they would emit, you know, 100 times more. So it's this is you know, tankers, although we don't like it, you know, it's kind of transporting really heavy crude on the oceans, which are really vulnerable, and all that. It's still a very efficient way of distributing energy. And since not all continents in the world are blessed with oil, you know, that's the best way to deal with this.
Definitely. So recently you joined Twitter, and you're a great ad for people who want to understand how Frontline and you think about the market. But what I love about your Twitter is that you're very quick to sort of, if you see an argument that doesn't make sense, you make it clear that you don't agree on that argument. So maybe that's a good framework to just answer the question, what do you think is the biggest misunderstanding that you see a lot of people with influence are telling us about the oil and gas market and shipping even?
Well, you know, I think I'll start at another point. One thing you learn after working kind of indirectly in the oil markets for many years is that nobody really has the answer. I mentioned that tankers are vividly volatile because you know, the market is not efficient. The same goes for oil as well. And one interesting fact that very few people know is that, you know, when you look at, say, the forward curve on Brent, you think that, okay, so 2024 Brent is priced at X. Ooh, you know, there's probably a lot of analysis behind that number. They really, really know what they're talking about. Well, it's a little bit like the tanker industry. It's like a mean reversion thing, and it's where the marginal production, you know, what the marginal production needs in order to make money. And also people think, ooh, you know, there's probably billions of dollars being put on 2024 Brent. Well, it isn't. You know, kind of a feisty hedge fund with an attitude can manipulate that curve very easily. So it's not like the currency markets where you would be blown out of the water trying to move it kind of outside of where it should be. But the oil market, you can actually do that. And then you have also the simple fact that, so we trade Brent. You know, Brent is the biggest oil contract in the world, and it's actually not more than about 700,000 barrels per day of Brent quality oil. And put that against close to 100 million barrels per day of consumption. You know, that little physical or relatively small physical contract prices, you know, the global commodity market. So not saying that that's kind of open for manipulation, because there's a lot of liquidity in the front end of the Brent curve. But, you know, people just have to understand that, you know, it's it's not messiahs. It's not like written in stone, whatever the oil analysts kind of figure out. And so obviously this is the demand side for tankers, right? And it's what tanker owners need to try and focus on, because that's what happens in the oil side on the curve, and also on oil refining margins and so forth are at the end of the day going to tell us something about where freight demand is going to end up. And the single most important part of that picture is, where are we in the inventory cycle? So is the world kind of full of oil, or is it marginally tight, or is it about to get empty? To understand inventories, one has to roll back all the way to the chart I mentioned, where you see the world on population and so forth. It's quite interesting to see that if you look at the most populous countries in the world with the highest demand of oil, they have the least production. That has changed to some extent in the US, but in Asia, it's if you do those two together, you'll find that demand-wise, China, for instance, is a massive blob. It's one of the biggest countries in the world, when you look at oil consumption, right? But on production, they're very small. And these countries that are kind of inherently short oil need to have a lot of inventories for security purposes. And whilst the production countries, they don't need that inventory because they have oil piping up from the ground already, every day anyway. So they're not too worried. And it's that dynamics when, in addition to, say, baseline demand, these oil short countries need to refill their inventories. That's where you get a very interesting dynamic in the tanker market, because that's when you start to see larger volumes than you would normally expect in baseline demand move between continents. And that is kind of one of the big themes we've had lately. During the pandemic, we saw the biggest drop in global oil demand at the shortest time ever seen, ever. Kind of, this has never happened before. This is like a true black swan, right? You have a global pandemic. It started to kind of hit the Western world in March 2020, and that was when lockdowns started to come and so forth. And suddenly, like off a cliff, oil demand just totally vanished. And that during a time where production was normally and relatively high, was actually incrementally high, because we're just coming out of a price war between Saudi and Russia. And that was when inventory started to build, right? The thing is that this inventories, all the big agencies report on inventories. So EIA does, IEA does, OPEC does, there are probably 3,000 analysts in the world, which main job is to figure out what is the global inventories like. But the only live information we have on inventories is coming from the US. And then Europe is more or less live, say monthly, more or less accurate. A lot of inventories in Europe is actually held in so-called commercial inventories. So it's the government basically telling a refinery to hold so much of oil in tank at any point in time. And then the rest of the world is almost dark. It's like you don't know where they are in the cycle, and in particular, China. So this inventory thing, and this is really important to the tankers, because if you can take from inventories, which is nearby the demand, is always nearby the demand for logical reasons, then that hits the need for transportation severely, right? When that stops, when you start to take the marginal barrel not from inventories, but you actually take it from a ship that's sailed on the seas, it has a huge impact. And it's like, so imagine if you come from a 1 million barrel per day draw environment and move into a 1 million barrel build environment, the delta is actually 2 million barrels per day. In order to transport 2 million barrels per day, you need 60 VLCCs, kind of give or take. So this has huge implications for the tanker market. I came out in 2021. I was pretty constructive, kind of in Frontline's quarterly presentations and so forth, and saying that kind of from the data we see, we're going to move from a draw environment into a build environment in August 21. And if you go back to EIA, IEA, and all these guys, what they reported at that time, that was correct. That was kind of what the analysis told us. Well, that hasn't happened. That's delayed. We basically, I think if there's a theme for all these kind of big analysts, it's misjudging when inventories are finished drawing, because again, half of the picture you don't know. So and that's like a rude awakening, which I had maybe some years back, but basically knowing that these truths are actually not truths. Kind of EIA, for instance, which is probably one of the most well-renowned kind of analyst bureaus out there. They're advising governments and the UN and whatnot. Even these guys don't really have a full grasp of what's going on. They think, and so do we, of course. But I realize I went out on a whim now. But getting back to my point is that this is one of the single most kind of important things for the tanker industry. Firstly, demand kind of coming back, which we apparently already have. Demand was north of 100 million barrels in December. We're down to 99 or something now. And then where are we in the inventory cycle? Where is the marginal barrel, or is the marginal barrel now coming on water? And I mentioned earlier that 40% of oil is in general regarded as waterborne. So if global demand is 100 million barrels per day, 40 million barrels per day will be transported on water. Well, the funny thing is that if you stop drawing from inventories and you start to use tankers to supply the crude, it has an exponential effect, because on our market, which is then say 40 million barrels, 2 million barrels is 5% increase in demand overnight, right? So it's not 2% of the total; it's 5% of kind of the barrels that actually do get transported on sea. So this is kind of one of the big things that we as ship owners look at. Investors should try and follow. And then you have, as I'm on the theme, there's another big one as well, and this is ton miles. If you rewind back to 2011, 2012, and actually DHT was founded basically on this principle. This was when U.S. production really started to come about, the fracking revolution. And everybody looked at the U.S. as a major importer, and everybody then kind of, called it the doom of the tanker industry, because suddenly this long voyage from the Middle East to U.S. was going to disappear. And because U.S. demand was a big driver in the tanker industry. Well, what DHT did, and probably a lot of people as well, but specifically DHT, was they did a thorough analysis of this. They even engaged Rystad Energy to do a case study. What is going to happen to all oil flows, when US stops being an importer? And the oil market is like a tube of toothpaste, right? So if there is one hole there and you basically stuff it, then suddenly the toothpaste comes out another place. So basically, the fact that US stopped importing displaced a lot of oil, and it opened up other trade routes. So for instance, West Africa to Philadelphia, which was a major trade route, became West Africa to China. So you recouped a lot of the ton miles that were lost on the Western runs. And suddenly, Mexico to US Gulf east, but Mexico to Europe and to Asia increased. Brazil suddenly didn't feed into the US refineries, it fed into China. So you actually had ton miles changing to the positive for something that was expected to be a doom to the industry, right? And I think this created a very tight market where the fundamentals actually told us it wouldn't be. It was basically ton miles increasing more than expected. And voyage days for tankers moved from an average, say, of 52, 55 days to 60 days almost, which is a huge change. So basically what's going to happen now then? Now we are in a situation where OPEC has cut. So OPEC has cut a lot of production. OPEC introducing barrels, particularly in the Middle East, doesn't help ton miles because it's a relatively short distance from where the big demand change is happening, which is in Asia. And so basically the introduction of OPEC barrels that we've seen recently it's created some increased utilization, but it's not kind of giving us the full benefit, basically because it's a relatively short distance. But what about the next step? When kind of more and more oil is introduced. So we're still, OPEC still has about 3 million barrels left to give, assuming they put 400,000 barrels back in the market in February, which is expected. Sorry, in March, which is expected. And we are having production issues in West Africa. We're having production issues in Libya. Brazil is working, but US is basically where US is at the end of the day the swing producer we have. So basically when we're back to not drawing on inventories and we need to build inventories, Middle East is back on, which is not far off already. That's when we're going to see the marginal barrels being pulled from the Atlantic basin. And that's when we kind of going to get back to the dynamics that we had pre-pandemic. I realize I now did the whole spiel in one monologue.
It's amazing.
I hope you have some questions. I hope you have some questions left.
Yeah, this is amazing because it's also, just a couple of reflections, right? I think maybe this answer is the reason why people love the tanker market, right? Because you need to have all these ideas and thoughts in your head at the same time, right? If you run a software company, you don't have to have all these thoughts in your head at all times, right? So, but I wanted to maybe, the next piece I would love to add on, because I had one theme left, which is the Frontline story, right? Because we have many listeners abroad who maybe don't understand the significance of course, this is a story of Jon Fredriksen, but it's also a story about how Frontline has catapulted a great, umbrella to all these industries or companies under, right? But before we answer that question, maybe just, do you want to say something about consolidation? Since everyone in the industry expects consolidations, or is it just a touchy subject to mention?
No, it's not a touchy subject, but I get that question every kind of time I address the market one way or another, whether if it's a quarterly presentation or an investor presentation. And it's consolidation, yes, we should have that, but consolidation is difficult. For us to grow as an owner, and I think investors need to know that we're almost religious, not placing orders anymore. We don't want to add to the burden in this market. We have kind of our idea of where the market will find this balance, and it's at least for the last 7-8 years, maybe more actually, 15 years, we haven't really placed any new orders in the market. So then when we think of consolidation, it's more acquisition, either acquisition ships that are already contracted or acquisition company or acquired companies that own ships. Well, we are acquiring ships that are ordered by others, and we've done so. The last year we acquired 6 resales, as they call. We also acquired 2 VLCCs from another owner that were on the water. But when it comes to acquiring companies, I think if when you ask the kind of consolidation question, you should think about the industry we're in. How many owners are there, or stock listed owners that are priced reasonably, well below NAV and so forth, and it would make sense for Frontline, who normally trades above NAV, to use our currency to acquire these companies, or one of them at least. It's really hard to do this in the shipping market, and basically due to the fact that most of these companies have dominant owners that actually want to be ship owners themselves, so they're not really open for an acquisition. They might be open for a collaboration, but they're also fierce kind of negotiators and have kind of ambitions on the value of their stock and so forth. So this is not like, first of all, you don't have a vast array of stock listed entities that you can go after. Secondly, the ones you have that are of the quality where you might want to do something, they have kind of shareholder structures or dominant owners that are not interested at all. So it's kind of easier said than done. But there are certain ways the tanker market can consolidate, and one of them is by forming kind of greater commercial units by way of pools, for instance. And there's a lot happening, and I think this is going to be an increasingly kind of theme for the tanker industry going forward, and this has to do with the regulatory framework we're facing. So we're a fairly big owner, and we have the capabilities of both coping with the planning, the reporting, the kind of optimizing with regards to dealing with our emissions going towards 2050 to follow the IMO and kind of basically keep our investors content from an ESG perspective and so forth. But there are many kind of marginal smaller owners that don't have these capabilities, and then it makes far more sense to join a pool that where you come to a set table where basically everything is taken care of. If you are, to use a bad kind of analogy, if you're a Greek owner sitting on an island somewhere sipping to your drink, you don't really want to have 10 people working on your ESG report. But if you join a pool, all this will be taken care of. But the challenge with some of the pools is that their motivation is not, or it doesn't seem like it's always the kind of return of the owner that's participating in the pool, because the pool is by nature transactional. The pool's income is generated from fixtures. So they take a fixed fee per day for managing the ship, and then they take a percentage every time the fixture is concluded. And the percentage is obviously then exposed to the freight market. So the higher the freight market, the better kind of the charter acts on behalf of the pool. Your income increases, a bit like the broker as well. The broker should actually be motivated to do the best deal possible for the owner. But what we've seen is that some of these pools become so large and they don't really apply the commercial power basically for utilization and for the transactional fee. So we've seen that although there are big pools in the market and they're probably going to grow, not all of them are probably best in class as to protecting the owner who's put his ship in their hands. But anyway, it's back to building bigger units, yes, but again, history has shown us that the fragmentation in the tanker market is really difficult to get around, particularly now, where tanker assets should be really cheap because the market is so poor. There's actually normally a great correlation between spot markets and the value of an asset. That correlation is a bit off now, and I think it's more due to the fact that some of these fragmenting owners, or whatever it's called, they have assets in all the various asset classes. So they've actually been making a bundle either in LNG or containers or dry bulk, and they don't really care too much about their dormant asset in the tanker industry that's just paddling around the world, losing a little bit here and there. So they're not really incentivized to do anything. So that's at least the feel we have in the market. So, but as I always say, you know, Frontline, we are in a great financial position to move when we need to move, or we want to move. And we're always looking, but it's tough.
Just a couple of quick questions left, Lars. I know we are running out of time, but you touched upon the reputation, and the reason why I just wanted to ask that question is because I guess reputation is built over time, right? So obviously it's not a short answer to why Frontline has a great reputation, and also maybe investors value the stock a bit more compared to others, but maybe it's easier to just explain the sort of investor or investment philosophy that Frontline tries to give, right? Because you touched upon it earlier in our conversation that Frontline has a specific philosophy that should be tailored for the investors on their behalf, right?
Absolutely, and you know, the shipping companies, listed shipping companies, have you know, a kind of, they have a various degree of reputation, or you know, it's not always you know, to an outside investor, it's not always transparent. The business model is not always transparent, and you know, it tends to be, you know, if you go on Wall Street and say you're representing a tanker owner, you know, the first question the investor will ask, well, where are you screwing me? Pardon my French. And you know, where are your hidden fees? So that's been a challenge to the tanker industry, and kind of basically made some investors hesitant to go into the companies. The thing is that for all the companies where, you know, we share the same big shareholder, transparency is really important, and it's basically, you know, I was thinking about that, and you know, this is something that's rarely communicated well. But if you look at the common kind of red thread, which is probably a Norwegian expression, the common theme amongst the companies that where we share the same kind of major shareholder is actually as follows. And this is from an old presentation that was given many years back, and it's basically, you know, it's keep it simple and focused, lean and efficient management teams, define where we are in this cycle, consolidation and economy of scale works, build credibility with customers, investors, and financiers, think and act like an investor. And this is all the management in the various companies' guidelines. So this is kind of, you know, this is the DNA of Frontline, Golden Ocean, Flex LNG, Avance, SFL Corp. So, and the investors seem to appreciate that. So, you know, at Frontline, we're blessed with relatively high liquidity in our stock. We have a brand name on the street. You know, when an investor or a trader in the equity markets kind of read in somewhere that you know, this is going to benefit the tanker market, he puts FRO into his Bloomberg terminal because they know about Frontline, right? If you look at what's happened to one of my good kind of colleagues, Øystein Kalleklev on Flex, you know, look at the development in liquidity in that share over the last kind of 6-7 months. It's just insane. You know, from being a US listed company with very few shares traded, now the volume in the US is larger than in Oslo at times. So it's or maybe even higher. I haven't looked lately. And it's basically to build credibility with your investors. And I think it's also very important for a tanker owner, and this obviously goes for Frontline as well, is that when you have a dominant shareholder, he will from time to time move into a position to buy assets when the listed companies can't, basically due to their financial situation. I think this is a good example from Golden Ocean. At some point then, this dominant shareholder, he does it not purely for his own profit. He does it because he thinks that will benefit the listed vehicle, down the line. So when you look at Golden Ocean, which last year kind of bought out, I believe it was 18 ships from our main shareholders, kind of private company, it was done at a fair market price, very transparent transaction, no hidden fees, no nothing. It was basically a fair market price, which even some analysts said it was on the cheap side. And you rarely see that in the world of the listed tanker owners. So this is kind of the key to how we build credibility with investors. Kind of the efficiency and low cost is always a theme for Frontline and our kind of the other companies in the sphere. But not, if you look at OPEX, for instance, kind of we share the same technical management platform. So the platform that manages the 75, 76 ships Frontline owns also manages the ships that Golden Ocean and Flex and Avance runs. And this gives true synergies. So basically we have a huge knowledge base to pull on with a relatively small organization. The technical management itself per ship is outsourced, but you have what you call fleet managers that are in-house, and they're overseeing the work that the technical managers are doing, and also then benchmarking the work they're doing. And it's not like we're going to save costs for any price, but by doing that, we at least have a mark-to-market on our cost, because we have different technical managers running the ships, and they're overseen by the fleet managers. So you'll find on OPEX that Frontline is outperforming most of our peers by 10 to 20%. So that's not where the big kind of savings is. But if you look at on G&A, since we're a small management team, we don't have a stock of kind of the amount of people running the fleet. It would be surprised many how a few kind of heads we are actually. So small focused management teams, which gives really manageable G&A costs. And then by building credibility with investors, but also financiers, we do access favorable terms on finance. So, and that's where the biggest kind of hit comes, or the biggest boost comes to Frontline, is our very low financial cost. The fact that a ship owner can place finance below 200 basis points for long-term financing of a vessel, for tanker, non-sustainable, I might say, it is pretty incredible. And this gives us a huge advantage and makes, this is why Frontline has what we like to say the lowest cash break-even levels, kind of, as far as we can understand, in amongst our peers. And it also gives or puts Frontline in a position to, when the market turns, very, very quickly return equity to our shareholders. And I think we'll at the end, kind of, we're coming to the end here, and I think this is probably one of the most important parts for Frontline and for investors in Frontline, is that when you invest in Frontline, you're not only buying a stock kind of per se, you are that, but you're also investing together with our major shareholder. You're basically partaking in his bet. And he is just as interested as the normal investor on return on equity, dividends, and so basically you're joining him in a trade. And kind of when we get into position to pay out dividends, and we paid out $6.2 billion in dividends over the years, and we're going to continue to do so when we have the opportunity to do so. And it's so you as an investor, you should feel safe that you're joining an investment with probably one of the most scrutinizing investors, on the planet, as far as I can understand, and I know. So that's kind of, and the other thing as well is that if you're interested in no volatility, a safe haven, and a steady kind of returning stock, low risk and so forth, and low beta, low volatility, whatnot, then you shouldn't really, Frontline should probably not be your core investment. But this is just by nature, kind of the proposition what we offer investors is more or less direct investment into an extremely cyclical industry, being the tanker market. So that's our proposition to the investor, and we're going to pay you, back for making that investment. But of course, since we're exposed to one of the most volatile markets in the world, the investment will be volatile too, but hopefully extremely rewarding, and it has been in the past.
That's a perfect ending, Lars. It was so much fun having you on. So thank you so much for taking the time.
Well, thank you for having me.
If you like this episode and the content we create, please make sure to check out our newsletter called the Byn Letter. More information is in the show notes.